This is Power Charting. I'm your host, Bruce Fraser. We have a great show for you today. We have special guest Chris Kimble with us. He is the purveyor and editor of Kimble Charting Solutions. He has a large and enthusiastic following, and we want to find out what all the fuss is about. I have put here on this page some key information for you because you know how it gets around here. We're going to run out of time. And so Chris has made a very special offer to our viewers, and you can reach it right here at this web address, also his Twitter handle. And let's get started. First of all, while we're at it, Chris is going to speak at the TSAAF in a webinar in early June. And so he's going to have more time to cover more material at that webinar. So stay tuned here for the date and time. Also, here is Chris's homepage. And so you can go to kimblechartingsolutions.com, and there's lots and lots of great free content here, and you can learn a lot more about what Chris does. And then finally, here is the page where the special offer is, and also a great video. So I want to get these in now so that you can see them. And let's meet Chris here in just a second. I'm going to change over the screen. Hold on. Chris, thank you so much for being here. We're very excited to see your charts and your work today. Thanks for being here.
It's a real honor and privilege, Bruce. Thank you so much.
Well, it's all yours.
Well, welcome everybody. Again, thanks, Bruce, to the StockCharts community. I'm a paying subscriber for years, and it's just one of the best sites out there for our type of work. So I want to just have some fun today, but I want to remind people this is my 40th anniversary or 40th year in the business. But the one thing that I want to remind people of is that I'm not a perma bull or bear. I think that's dangerous to have that type of an attitude, but I am a perma bull when it comes to opportunities. And I kid people, Bruce, that the name of my company is not Kimble Charting Problems, it's Kimble Charting Solutions. And so I think there's lots of solutions and answers in the charting world. But before I kind of get started in the presentation, I just want to share that my friend and mentor, I promised Sir John Templeton years ago that when he shared with me, Bruce, that outside of the Bible, the book that he had learned the most from in the business community is this book, and it's The Extraordinary Popular Delusions and the Madness of Crowds. And so for anybody in the audience that hasn't read this book, I'd really encourage you to do that. I think it'll change your perspective on investing, and especially I think it's kind of rather timely, Bruce, with the virus situation that we have in play.
That
right
book,
now.
which I've read more than once, was 100 years ahead of its time. Remarkable book. So excellent read. Everybody should read it.
Yeah. So just as we get started today, I'd like Truman's comment that there's nothing new in the world except the history that you don't know. And so as a little reminder today, things I'm just going to try to touch on briefly, and I look forward to speaking again at the San Francisco conference, Bruce, and thanks for that. I want to talk about multi-decade trends and how they've not broken the recent decline. We're going to investigate what I want to call the 450s. What did the four largest bear markets in the last 100 years, did they have anything in common? We'll go and investigate that today. How tech strength is actually testing 2000 highs, and so we have to ask ourselves, are we going to see a breakout or is a double top taking place? Banks have sent a bearish message to the stocks for 28 months, and what are they saying currently? We'll look at, if we have time, that gold looks to be creating a 9-year bullish pattern, and also commodities and yields look to have created one of the largest bullish reversal patterns in decades at multi-decade support. So we'll try to get to that towards the ending. So to get things started, I love, as you said, Bruce, long-term trend analysis. And so one of the interesting things, if this is the Dow going back 100 years, There's a lot of talk of, similarities between now and the depression of 32. But if you just take the 32 low and then start taking the stair-stepped highs and you create a long-term trend line, it was interesting that it was hit in 2000. And then you do a parallel of that and lay it on 1980. We know that we had a sharp decline of late, but the thing that I want to share is there's really a confluence of two different multi-decade support lines that was hit in March, and they didn't get broken. So from a 30,000 foot view, the long-term support is in play. Now, I will say, that's why I want to make the audience aware of this. If this, it's either a 40-year channel, or if you go back to 32, it's a 90-year channel. I'm not going to split a hair over that one, but if this dual support, the red arrow would break, I'd have to say I think the long-term trend is we've got a change at hand. And so when we look at the NASDAQ, we got a similar situation. This is going back into the 90s, Bruce. And so we've got a test of the support that was hit recently. We'll see two different support lines that were hit in March. You see a large monthly bullish reversal. So the trend in tech is still up, as most of the listeners know. Tech is stronger than almost any other indice out there. But if tech would happen to break just below the 6,800 level here at the red arrow, we would have a dual break of support. So the long-term trends, I think if I always like the analogy, Bruce, of if you took a person heading up on an escalator in a yo-yo, I have found in my 40 years that a lot of people focus on the yo-yo and they forget that the guy's on the upward escalator. So these two charts show that we're still on that upward escalator, but we've also shown where that long-term trend could change if the channel support gets taken out. So one of the things that I find fascinating in today's topic we're going to look at is the 450% bear markets and repeating patterns. But I find it fascinating that that Fibonacci takes place in nature. We all know that, but it doesn't matter whether it's hundreds of feet below sea level or the same pattern takes place. I'm from Kansas, and this is our sunflower. We see the similar repeating pattern in the Kansas sunflower. If you're in a satellite and you look down on a hurricane, you see the same pattern. If you look into the galaxy light years away, you see the same repeating pattern. And lo and behold, we also see the same repeating pattern in Washington, D.C. And so today I want to talk about looking back, Bruce, over the last 100 years. What I look at or want to discuss is the 450s, the four biggest bear markets in the last 50 years. And do they have anything in common time and price wise? So that's what we're going to dig into today. So the first 50% bear market, one of the four biggies, actually it was a 90% decline, was the decline between 1929 and 32. But the thing I want to focus on is you had an initial decline, and then you had the first quality counter trend rally. That counter trend rally came up to the 50% Fibonacci level. It spent, Bruce, almost a month there, and then it rolled over, and then that's when the bear really started growling and pulling out its claws, because the majority of the 90% decline took place after the Fibonacci 50% level was hit. So then we turned the page to 73, 74 when Nixon was impeached. We had a 50% decline again. Do we see anything in common? Well, the first counter trend rally spent about a month at the 50% retracement level. When it couldn't penetrate it to the upside, then the majority of the bear market unfolded. Turn our page to 2000 to 2003. The first counter trend rally took place and ran out of steam, essentially on a 1 week reversal, Bruce, at the 50% level. Then the majority of the bear market continued. Turning the page to the 2007 to 09 bear market, we have a similar situation. First counter trend rally spent about a week below the below the 50% retracement level. Couldn't seem to muster enough buyers to get above that, and then the majority of the bear market fell. So if we were to try to put this into a spreadsheet, one of the things that I found in common, it's a little busy here, but just keep in mind, here are the four bear markets that we discussed. But the thing that I wanted to try to focus on when we discussed time and price, Bruce, was what were the start and ending dates? Was there any commonalities of the bear markets? Well, a couple of things stuck out to me, that the last three 50% bear markets, the counter trend rallies, I don't know what the odds of it are, but each of them, the counter trend rallies lasted 8 weeks. and then that was it. And the retracement level that was hit by all four happened to be the 50% retracement level. So when we put them together, 3 of the 4 counter trend rallies lasted 8 weeks, and they peaked at the 50% retracement level. So the counter trend rally, Bruce, essentially started at the first week of spring, March the 23rd. So 8 weeks would take us to next Friday. So from a trading perspective, we're 5 trading days away. So as we discussed yesterday, if you look at hand grenades or nuclear bombs, we're essentially there time-wise. So are we there price-wise? So to summarize this, if things would happen to repeat, the 2 time and price scenarios is to watch closely around May 23rd to 25th, and the 50% retracement level on the S&P happens to be 2,800. So from a repeat perspective, one thing I found, this is what I was sharing with our customers, Bruce, is that I don't know why it happened. It's above my pay grade, but the first counter trend rally in 2001 took place the first week of spring, and it did the same in 2008. You can see these highlighted in the green arrows. So if we're repeating time-wise, and we shared this with our customers on March the 23rd, it was time for the counter trend rally to start. And also at the same time, the time was there, the market was hitting, the S&P was hitting this 10-year rising support line. And so in hindsight, when we look back over the last, 6 or 7 weeks, we've seen one of the largest and sharpest short-term rallies in the history of the stock market. So it's come in right on schedule. It started right at the first week of spring, and we've seen something strong. So now we want to look at price-wise. Do we see any commonalities with those bear markets of the past? Well, the S&P has surpassed its 50% level, so it's doing something a little different, but it has spent the last 3 weeks at the 61% retracement level. But what about the Dow? Well, the Dow's now spent almost a month at its 50% retracement level. NYSE has spent a month right at its 50% retracement level. Mid caps have spent the past 3 weeks at the 50% retracement level. Small caps have spent the last 3 weeks at the 50% retracement level. And the weakest of the week are transports, and they've spent a month at the 38% retracement level. So as we look back, remember the 450s, they lost 50%, but they also retraced at the 50% level and ran out of steam. So we're still right in line in time and in price so far. And so it's not only us that I kind of find fascinating, Bruce, is what about turning the page to Europe? Well, Germany has spent the last few weeks just below its 50% retracement level, and we're starting to see a sell-off. France, it's a little weaker, but it's spent the last several weeks at its 38% retracement level, and London is just below its 38% retracement level. So we're ideally, it's not proven, but I think the biggest question that we all have to ask is, as like MAGA hats have become popular, I want to suggest to take the MAGA hat off, and you've got one of 2 hats. Should you buy the dips or sell the rallies? Well, the first couple of charts were suggesting that you buy dips. So now what we're wanting to see is history repeating itself enough that we move from buying the dips to selling the rallies. And so we're going to continue to, with our clients, it's kind of like a lot of us might be doing some Netflix binging, Bruce, during the quarantine. We're doing updates to our customers every week, on this kind of saga to see if the 450s are repeating themselves.
Well,
Not
interestingly, last week, I did a segment in power charting on the 50% rule as applied from the Wyckoff method, which is not a widely known rule, but it completely follows the logic of what you're presenting here. Very interesting.
Perfect. So when I did the analysis, Bruce, I was shocked to see that each of those counter trend rallies just essentially stopped on a dime at 50. But as I spent 40 years doing this, a lot of times this math, and it always surprises me, but in some ways it's not surprising. So the one thing that's not at a 50% retracement level or a 61% retracement level is tech. As we all know, tech is really strong. It's where the strength is. But I find this really interesting, that this is the NDX NASDAQ composite ratio. So in other words, we're comparing 100 tech stocks to, like, I think 3,300 tech stocks. I apologize if I'm wrong on the exact number of holdings. But the thing I find interesting here is as this ratio rises, that just means fewer and fewer of, quote unquote, the FANG stocks are holding the market up. But it has rallied now for 18 years, and it's at, what's ironic, the 2000 levels. So what would the bulls love to see? They would love to see a breakout above 2000 highs and continued strength here. And what would be a bear's wish or a bull's nightmare would be is that we have a double top in this ratio that's reflecting fewer and fewer stocks are holding things up. And you see, this is a monthly chart, back-to-back bearish reversals at the same price as the 2000 high. So it'll take some time, but when we think of the 450s, the bulls would get a very concerning message if we'd see a double top in this ratio 20 years later. So I find this fascinating that all of this is working out kind of the way it is.
I would also point out that in Wyckoff, we're very focused on climaxes. And just as in 1999, 2000, there was a climax in that index, there was an acceleration and climax into that resistance line that you had drawn. And so that's the other thing in that chart that is so fascinating, is this sudden acceleration right into that red resistance line, and it's climactic. So the conclusion you draw from that is that this index is either range bound, or, as you're saying, possibly creating a double top. So very interesting look there, and very unique picture. So interesting.
Yeah, we'll obviously want to revisit this, going forward. So tech is the strongest, but I want to talk about then one of the weakest, Bruce. And a lot of people say that the decline and the virus were a black swan event. I'm not going to argue with people, but I don't think to me, a black swan is something that nobody was prepared for. And when Hollywood's made 3 movies about viruses, so I think Hollywood was ahead of Hollywood ahead of the trend, or this really wasn't a black swan event. So I'd take choice B. And then what we've been sharing with our customers now for over 2 years, in the upper left, Bruce, is the BKX, or the bank ratio, divided by the S&P 500. And as we see this heading down now for 28 months, and I love the phrase, I didn't invent it at all, but so goes the bank, so goes the broad market. A lot of people talk about this as a virus situation, not a financial crisis. But the bottom line is our system, our financial system, has been expressing concerns a couple of years before the virus ever became a household message. And so this piece that's coming up, Bruce, looks at major indices performance since banks started turning weaker in January of 2018. And I know it's a busy chart, but the bottom line down here is the S&P's flat over 28 months. We see a lot of people talking about, wow, we've had a bear market this year, and then we've had a bull market rally, just in the last 6 weeks or whatever. But I still beg people to get in I know you may not want to get in an airplane right now, but go up 30,000 feet and look down, and you can see that the S&P is essentially flat over 28 months. The Dow's down 10. The NYSE is down 18, mid caps are down 19, small caps 20, EFA 25, and banks and emerging markets are down almost 30. So as the banks have expressed weakness and this signal, to me, this isn't a black swan event. Banks have been suggesting concern for the overall market long before the virus, it's crept into, our healthcare system. A tool that we have that's proprietary to our members, Bruce, we call the Shoebox Indicator. It's been a great leading indicator for bull and bear markets. And my name probably wasn't very creative with it, but the idea of the Shoebox Indicator is when it's sending a positive message, it's risk on. You want to have the shoebox. Don't hide your money under the mattress or under the bed. Get it out and put it in risk assets. But on the flip side, when the shoebox indicator sends a negative message, you probably have a protection area and it's risk off. So the trend, especially since Christmas lows of 2018, has been higher. But the thing that we made our customers aware of, that the rally in this indicator going into the very first of this year and Christmas of just this past year was testing 2017 highs. So this was a resistance level. And at the same time, this resistance level was being touched on the underside, a bearish rising wedge was forming. And so this indicator, the shoebox indicator, broke support in January of earlier, this year up here. And so it sent a concerning message to the broad market before it started rolling over. But so updating things to now, you can see that it just had a waterfall pattern. It fell hard. It's had a strong counter trend rally, but now it's kissing the underside of what was a support line 3 different times between 2015 and 17. It did break it at the Christmas lows and then reversed accurately higher, but it's kissing the underside of this resistance. And yesterday, Bruce, the indicator was down 450 basis points, which was fairly negative, and we have the same move again this morning in the indicator. And so that's very concerning to see the shoebox indicator seeing a sell-off right on the underneath side as it's kissing this long-term resistance channel. So that's a concerning message.
Yeah, classically vulnerable place. So.
Yes, very much so.
Yeah.
So as I go to wrap up, Bruce, I appreciate so much being on here today. And as you mentioned at the top of the show, we've got a special going on, and in honor of being on the show and my 40th anniversary. For our most popular package, we have 3 different research reports, Bruce. It's $134 a month, but we're offering a special trial offer here to correspond with my anniversary, that you can get all of these reports for $40 for 3 weeks, and it's 70% off. And as you mentioned early in the show, Bruce, you can just go to kimblechartingsolutions.com/StockCharts, and you can sign up for that.
Well, thank you so much for making that offer to our viewers. This is, I'm sure there's going to be a number of people that are going to really want to see more of your work. And
how are we doing time-wise, Bruce?
I think we have about 5 more minutes, and so yeah, we can keep going. And
I got just a couple of other charts, Bruce, that deviate from the main talk about the 450s today, but I just wanted a couple of fascinating things to me is from a big picture perspective is this is a picture of gold going back 40 years on a monthly basis. And the thing I found interesting is if you took the high of the Hunt brothers in 1980 and the low in 1999, and you applied good old Fibonacci to it, the 261 extension level of the 80 highs and 1999 lows came into play right up here at the 1900 level. And you can see on this monthly chart, there was back-to-back reversals, which essentially put the nail in the coffin for a while for gold. But essentially over the last 8 to 9 years, to me, it looks like gold is completing a long-term bottoming pattern. It looks to be an incomplete cup and handle without a handle. But the key is if gold can break above, which I believe that it will, the 1900 level, the next target based upon the 1980 highs to 1990 lows, Bruce, is almost 3,000 an ounce, which is the 423 extension level. So this is something that I find fascinating from a 30,000 foot view. And then the one that it's kind of hard for me to really believe, but time will always tell. The world's a lot smarter than old Chris is. This is an overlay of the Thomson Reuters equal weighted commodity index going clear back into the 70s. And then this is the yield on the 10-year note. And the thing that I find interesting is, the movie The Darkest Hour by Churchill, you'll notice that the 1980 high was hit at the lows of the financial crisis, and it created this monthly reversal pattern here at support. And here we're back there again in commodities, and it's made back-to-back bullish reversal patterns. And at the same time that is happening, yields are testing a 25-year falling support line. And so, like this guy says, is it really possible that commodities and yields are bottoming at the same time? The trends are still down for both. So the jury is definitely out, but from a contrarian point of view, it's just kind of interesting to me that the billions of free-thinking people, that they both created bullish reversal patterns at multi-decade support in these very contrary assets to our times. Because as we worry about a contraction in the world and the Fed trying to move rates to zero, it's kind of interesting that the top chart might be saying that commodities have hit a low, and the bottom chart would say maybe interest rates have hit their low, as well at the same time.
This is such a beautiful contrarian set of charts. And I think about your mentor, Sir John Templeton, and what a great contrarian he was. I mean, he was just so good at finding the contrary valuable idea. And this chart just really shows the power of being able to find that. It's really
Great point,
beautiful.
Bruce. Great point.
Yeah. And the other thing is that I just heard that month of April, that food prices in grocery stores had like their biggest jump in forever. Don't hold me to that, but it was
Right.
a very long time. And so there could be those early signs of things changing. So and that could just be anecdotal to your chart here.
Yeah, these things always do surprise me, and I know, like, that's why I put this guy scratching his head. From many ways, it doesn't seem to make sense, but I don't try to spend a lot of time on the why these things are doing it. I just try to observe the behavior of billions of people. And I'd express concerns to Sir John in the past, Bruce, and he would always say, "Chris, do you know a secret that the smartest people on the planet don't know?" And I always say, "Well, no, I don't." And so I've tried to give up on the secret part and just recognize chart patterns, and that they're just so helpful to myself and my family and customers and friends.
Well, this is wonderful work. I can see why there's so much enthusiasm for your chart work and your market studies. And I'm just really grateful that you came and spent time with us today. And I'm really excited for the TSAAF webinar that you're going to be doing. And I am hopeful that you'll come back here and see us again on Power Charting.
It's been a real honor, Bruce, real privilege. I thank you so much for inviting me, and I'd love to come back.
Wonderful. And everybody keep in mind that there's a great offer available for our viewers. And you can see that just by going to the homepage at the beginning, and that web address is right there. So Chris, thank you so much for being here, and we'll see you again soon.
Thank you, Bruce. You're a real champion to the individual investors. Thank you so much.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.